What are the specific capital gains rules for farmland? Imagine turning farmland into a profit and wondering how much of that gain will go to taxes. When you sell farmland, the rules about capital gains can seem complicated, but they're manageable once you understand them. First, the profit you make from selling farmland is called capital gains. It's calculated by subtracting your property's tax basis from the sale price. The tax basis is usually what you paid for the land, plus any costs for improvements like fencing or drainage, minus any depreciation if you use the land for farming activities. If you inherited the land, the basis is stepped up to the current market value at the time of inheritance. This means if the land was worth $50,000 when you inherited it, that becomes your new basis. Selling soon after inheritance might mean little or no capital gains tax because the gain is minimal. For farmland held longer than 1 year, the gains are considered long-term. Long-term capital gains are taxed at lower rates than short-term gains. Currently, these rates range from 0% to 20%, depending on your income and filing status. For example, single filers pay 0% on gains up to about $38,600, 15% on gains between that and for $125,800, and 20% on gains above that. Married couples filing jointly have higher thresholds. Additionally, if your income is high enough, you might owe a 3.8% net investment income tax on your gains. When farmland is sold shortly after inheritance, the stepped-up basis often results in little to no capital gains tax. But if the land appreciates significantly after inheritance, you'll owe tax on the difference between the sale price and the stepped-up basis when you sell. There are strategies to manage or delay paying capital gains tax. One common method is an installment sale, where you receive payments over several years, spreading out the tax liability. Another option is a $26,250 per person exclusion for the sale of a primary residence, but this doesn't apply to farmland unless part of the property is used as a home. For farmland as an investment, a $21,500 exclusion applies if the land was used as a residence. A $21,500 exclusion can reduce taxable gains if you meet certain conditions. You must have owned and used the land as your main home for at least 2 of the 5 years before selling. The land must be your primary residence, not just farmland. If you qualify, this exclusion can significantly cut your taxable gain. Another popular tax deferral tool is a $26,250 $21,500 exclusion, which can be used once every 2 years. It's important to keep detailed records of your purchase price, improvements, and any inheritance documents. Consulting a tax professional familiar with agricultural real estate can help you develop a plan tailored to your situation. Understanding these rules helps you plan the best time to sell, how to structure your sale, and how to keep more of your profit. Proper planning can make a big difference in your overall investment returns and ensure you stay within legal guidelines.